What's up, guys? Eric here, Mr. Fired Up Wealth. Want to bring you a real talk today. I've had several people ask me kind of what I'm doing with the portfolio. I've been in Discord for the last day, 14 hours yesterday. I spent in Discord, work with the community, updating what I'm buying and selling. I wanted to bring a video to you guys just to let you know my general thoughts of the market and maybe bring some comfort to you. You might be panicking. Here's the thing. The market, we have lots of different things going on under the hood, and you've probably heard all this before, but just to kind of recap it. So you've got inflation that's running pretty hot, 7%. Now, the way to kind of fix that inflation problem is the Fed raising interest rates, which are still very historically low. Now, the problem when you raise interest rates, of course, is it's going to cause kind of a multiple suppression on some of those high PE type stocks. So interest rates are bad, but then you look at inflation. Inflation actually, if you're not in the right company, you get in the wrong stock, inflation actually could eat at your gains. I mean, if you're in a company with no growth, you might not actually do very well with those type of stocks. So you've seen the NASDAQ, over the last 5-10 years outperform. You look at the S&P 500 even, we've performed closer to 15% annual returns, and the historic mean is 10%. So a lot of people argue that we were in this everything bubble, everything was too expensive. Now, what's interesting from an economist type perspective, when you think of the stimulus that was pumped in, you had quantitative easing, and now it's going the other way, quantitative tightening. But it's hard to really measure what that $2 or $3 trillion of stimulus really did. And a lot of these stocks have actually come back to pre-COVID levels. You look at a lot of stocks out there, they're actually trading now cheaper than before the pandemic even happened, just kind of erasing the pandemic off the slate. And a lot of that has to do with that compression of those multiples. So what I'll do today, guys, is I'll give you a couple stocks that I think can do well in this environment through the rest of the year. I'll also discuss what I think about growth stocks and just what I think the market will do next. And of course, I don't have a crystal ball, so I do my best to give you my thoughts. And I've been doing this for almost 25 years. I started investing in the late 1990s, and I've seen it all, from the dot-com bubble, the financial crisis in 2008, 2009, all the tapering in between there, the 2020 pandemic, on and on. So I've seen a lot of these sell-offs, and I've had people say, well, you're not worried because you're financially independent. And I'm like, I'm trying to explain to you the reason I'm financially independent is because I've had this mindset. I've had this mindset that I'm going to buy quality companies. I'm going to hold them for the long term. There's going to be ups and downs, but those companies are going to be worth a lot more in time. So if I have appropriate time horizons and I'm thinking 2030, my stocks are going to be worth a lot more, even though they might go through some pain right now. So just looking at the overall, market, we've got tomorrow there's a Fed meeting, and that's going to be really important. Of course, if they decide to raise rates now to kind of combat inflation, you could see the market gyrate from that. The expectation right now is they're going to wait till March to raise rates. Some people are starting to factor in a fifth rate hike. I still think we probably have 3 or 4 this year. 4 is probably the safest bet. A lot of people are trying to say 5, and it's possible, but to me it seems unlikely, but anything could happen. You're also seeing things right now with Russia. You got tensions with Russia. So lots of different undercurrents all working against each other. And when you think about institutional investors, I've said this before, they're thinking about 6 months out. They're not thinking about 6 years out. And so a lot of times they'll just wait on the sidelines. They'll sell stocks. They'll even trade. So like yesterday, you get kind of a dead cat bounce, and then they sell some of those gains this morning, and you're seeing, a retracement of maybe half that. But if you look at yesterday, the NASDAQ was down about 4.9% intraday lows. It closed up positive 0.6%. So really it would have to go down 5.5% today to get back to kind of retesting those areas that it was yesterday around lunchtime. And I did buy some stocks yesterday, during that lunch break. There's a few things I added to. I generally think when you see that much, in my opinion, I saw capitulation where people are just panicking and dumping. And there were some articles about how retail dumped, over $1 billion, and basically, Wall Street came in and bought that. And I understand $1 billion is peanuts when you think of the grand scheme of things. But the idea behind that, if you really look at it, is that's what Wall Street does. They push retail until they basically break. Retail eventually panic sells, and then once they think that retail's kind of sold out, they go and buy those shares for cheap. And I mean, it's just a fact. That's the way the game works. The rich get richer. And if, let me back up. So there's three tiers of stocks right now. Okay. If you had meme stocks, SPACs, really super high risk, speculative with zero earnings, just a story, those stocks aren't going to perform well in this environment, and some of them might not actually recover. Some of those might go out of business. Then you've got the middle tier. That middle tier, tier two, is going to be, things like a Snowflake that has a crazy valuation, but it's a solid business, solid leadership, and eventually they've got that path to profitability. It's going to take time, but investors can see that story and they're willing to pay a premium for that story. Then you got what I call the tier one, and that's going to be a blend. So most of you are probably growth focused. I try to teach a balance of DGI stocks, dividend growth investing type stock, DGIF, ETFs, growth spec, and managing that. So like my spec, I say 10% or less in the portfolio, and then say 10 stocks, 1% in each. If you have a whole portfolio of spec, obviously there's a lot of beta there and you're experiencing a lot of pain. I also teach to have cash, 5 to 10% cash, so that you can take advantage of these opportunities. And I understand eventually you run out of cash, but the idea, guys, if you're still working, you're getting a paycheck. Every paycheck, you're taking what you can and you're buying stocks when they're down. So accumulation is really where you can build wealth, not during those euphoric bull runs. The problem is that our brains want to buy a stock and have it go up the next day. We have this overconfidence effect, like Morgan Housel teaches, where you think that you can just time the bottom, buy a stock, and it's going to go up every day from that point. And, we like to chase those shiny objects that are going to make us rich quick overnight. The reality is that investing, guys, it takes a long time. Being financially independent where I'm at now, it took many years of investing and going through a lot of turmoil, ups and downs, and just having conviction in what I owned. Sometimes you're wrong on stocks, but the majority of your basket, is going to be winners, and that basket's going to outperform the market, do well, and put you in a position to have a better life later on. So you have to ask yourself, why are you investing? If you're a trader, there's nothing wrong with trading, but then, you've got to be nimble and you got to have stop losses. You got to get out when the market turns. Timing the market. Some people like to say, well, why don't you just sell everything? And there's YouTubers out there, liquidate my portfolio, I'll get back in later. If that's what you want to do, that's your prerogative. For me personally, it's worked for me to just accumulate, buy what I know. And if my target's 2030, all the stuff I own, for the most part, is going to be worth a lot more in 8 years. And I just accumulate more shares when it's down. If I go and sell right now, a lot of my stocks, they're way up still, even if they've come down. The majority of them are. And I'm going to pay huge tax ramifications to do that. So you have to do what's best for you. I'm not telling anybody what they should do with their money because I'm not your financial advisor. But I'm hearing a lot of chatter about, should I just liquidate my portfolio and buy it back? Good luck catching that and timing that. Unless you did it, before the crash started happening, the sell-off started happening. If you didn't do it before then, it's going to be really tough to time that. You saw what happened yesterday. We literally had the biggest turnaround day in NASDAQ since, I think, 2008. We were down 5% and literally closed positive 0.6%. And some stocks literally had 15, 20% changes from downside to upside if you do the math. That's pretty volatile, and you got to be careful. You got to be careful with that. So it's kind of a hard blend where you have to be patient. You can't just throw all your money and try to time the bottom. You kind of dollar cost average at different levels. If it goes a little bit lower than it was yesterday, then I buy a little bit more. Eventually I run out of cash, and then I hope that the market stays down so that I can keep adding more shares. So here's what I think is going to happen. I think that over the next several months, it's going to be tough. So if you look at the average recovery from a 15% correction, usually it's about 4 months, something like that. So anywhere between 1 and 4 months, usually about 4 months on average. So if you figure this works itself out and the Fed doesn't do anything drastic tomorrow and it works itself out and we don't go to war, there's all these macroeconomic events. So here's the thing, like technicals at this point, they're almost useless because if something happens, a catalyst, like a fundamental, a macroeconomic catalyst where we go to war, all those technicals are going to be off the table. And a lot of technicals are just broken anyway. So people trying to guess the bottom on specific stocks or even the market, it's just silly because it's really hard to do. Now, I think yesterday, I said this earlier, I think yesterday is a time to buy, even if it goes lower, because I did feel some capitulation. It's the first time I've really felt that in a while. I, of course, felt that in 2020 during the pandemic. The time before that would have been December 2018. And it felt very similar yesterday to December 2018. So I think what's going to happen is you're going to have those 3 tiers of stocks. And the tier ones are going to recover quicker. The tier two are going to take some time. So when you think of like the crowd strikes and things like that, those might trade at lower levels. Maybe not at the bottom. They might bounce a little bit and recover, but they're not going to go back to all-time highs. They're going to trade lower, and it's going to take them time to consolidate and kind of grow into themselves. And that might be several quarters. I would think for the most part, you're going to see the market kind of take its time over the next several months, maybe through spring and summer. Now, if you're in Discord, I've been saying that we'd have a correction in 2022. But my crystal ball was broken, and I didn't guess it was going to be January 1st. I thought it was probably going to be somewhere around March. So I still expect some volatility. If you look at presidential terms, generally that second year in that summer, midterm elections, usually you have some choppiness there. And overall, before the pandemic, it was sell in May and go away. If you haven't heard that term, sell in May and go away, usually there's less volume and there's a lot more volatility. When you think of May through the summer when kids are out of school, people are on vacations, things like that. So I expect, first of all, we'll know a lot more. The market doesn't like uncertainty. So right now we have too much uncertainty. And so money managers aren't just going to go all in. They have to be, they have to basically do their job, and they have to be that fiduciary for their customers and say, hey, if I go in here and it falls even lower. So they've got to be really careful. The difference is, again, is they're looking at 1 year type returns. And if you have a longer time horizon and you're looking at NVIDIA at 225, you might say, hey, that's a good buy. It's still a 50, PE for next year's sales or, price to earnings ratio. But if I look at that stock over the next 5-10 years, I think it's going to be much higher. Could it go lower? Sure. And I'll just dollar cost down. That, for me, that's the mindset I like to have. And I like to try to tune out the rest of the noise, because you're not going to be able to predict the future. You're not going to be able to time the bottom. So I think a few stocks that I really think would be good in this environment. I think Google and Facebook, even though they have regulatory potential, Department of Justice, DOJ, potential scrutiny, right, for antitrust, I think both of those are trading somewhere around 20 right now. So, I mean, to me, that's pretty inexpensive for the quality there. They've got rock star balance sheets. They've got lots of things going for them, especially Google. Google I'd pick over Facebook personally. And then Amazon. I made this video a couple months ago before we had the sell-off. And I said, if you can get Amazon, it's close to $3,000 a share. That generally, and historically, when you look at that price to sales ratio, it likes to kind of bounce off that. Now, the tricky part with that is if we're revaluing everything at a lower price to sales and price to earnings type ratio, then that could actually compress the stock, and that's why you're seeing it closer to $2,800. But I think in this range, like $2,750, even if you were to revalue it from the $3,000, I personally think that that's going to be one that will recover faster. I think they're positioned well for the second half of this year, the back half of 2022. So Amazon, Facebook, and Google, those are the three that I think could do well. I also really like NVIDIA. You got to keep in mind that, institutions, if they're going off a playbook, they're going to see the price to earnings ratio. And I'm not saying that price to earnings ratio is everything. I'm just telling you what institutions are going to do. And they're going to say, oh, it's still a little bit too expensive. With that said, it's also a popular stock, and I could see that one recovering as well. So those are like the four. Tesla is also another one where I could see institutions getting in that, and they're going to have earnings here that could blow it out of the water for all we know. Microsoft, Facebook, Amazon, then NVIDIA. If I look at tier two, I still like the CrowdStrikes of the world. I noticed, Sentinel-1 was down yesterday to like $36 or something like that. HCP got way low, and they both bounced back really fast from those lows. The candle's just like a wicked quick candle snapback. So those kind of stocks, though, with the high, price of sales, they're not profitable yet. Those are still tier two, where people are going to put value on them, but they're probably not going to recover right away. So I think you'll probably have time to get into those names and accumulate. So if I were trying to use my money and say, where should I put my money now? ETFs are good, DGI stocks, dividend stocks. So if you look at some of the names, Lam Research, NVIDIA has a little dividend, things like that. Microsoft's good because it gives you both. Microsoft actually pays that dividend. So that's probably one of the most popular stocks right now. And then Google, Google and Facebook are just cheap compared to Microsoft, but Microsoft pays that dividend and it's high quality. But those type names, I like the other names like Apple, Netflix under 350, Facebook under 300. I like those. Those are where you might want to put money, maybe first. But with that said, keep in mind that the stuff that's really beat down, like some speculative type names, if you really like those could have a quick snapback, but sometimes it's more of a trade. It just kind of bounces and then it kind of fades and it retests again. So keep that in mind. That could happen with some of those lower quality names. You might see a bounce, but it might not hold, and it could kind of, fade and go back lower and retest. So I would focus on those tier 1, then the tier 2. So I think of the SaaS names, those are probably tier 2. Even like a Roblox, a Snowflake, a CrowdStrike, Zscaler, they're still really expensive stocks, and it might take a while for those to recover. And then tier 3, to me, guys, you just have to try to avoid those unless you're trying to play a bounce, or if you have crazy conviction in a stock and you're like, I believe this stock's going to be awesome in 10 years and I'm willing to take the pain knowing it could go lower and I could buy more, then that's your prerogative, And everything I'm telling you guys, not your financial advisor, and you also have to keep in mind, I always dollar cost average. I buy in chunks. When it's volatile, I'll probably buy 10 lots instead of 5. So let's just say it's not crazy volatile and we're not going through a crazy sell-off. I might do 25% at a time. In this environment, yesterday I did a little bit heavier on some names when I thought we got to capitulation. But if I were buying right now, I think the Nasdaq's back down 2%. I might only take a 10% chunk, meaning I can buy 9 more lots and kind of dollar cost back my way into it. So it's really nibbling, then if the market turns, you can always pay a little bit more. You just have to be careful not to panic sell, in my opinion. If that's what you want to do and you think it's going to go lower and never recover, that's your prerogative, it's your money. But I personally be careful of panic selling. That's where retail loses money. What happens is they buy tops, it gets sold off. They buy high, they sell low. Wall Street takes their money. Those people disappear. Then the next euphoric bull run that we have, they come back and they chase the top again, rinse and repeat. The money is made, guys, during these times of volatility when things are cheaper. And I understand that there's this revaluation of stocks and price of sales and PE and all that. But you have to remember, too, that the quality companies will still grow, and they'll grow into their valuation. Now, the R word comes up, recession. A recession is 2 quarters, basically, when you have reduced GDP. And so a lot of people, they think of like the dirty 30s, and it's like this 10 years of just suffering. And it doesn't necessarily have to be that. Obviously, it's bad. I'm not saying it's good. But understand what a recession is. Right now, we're not there. The idea behind it is you raise rates. Inflation doesn't go away fast enough. People don't spend as much. They don't spend money on gas, so they don't drive. They don't buy stuff at the grocery store because they can't afford it. They don't go out to eat. The economy slows, then jobs slow. You've got higher unemployment rate, and it's just this snowball. Businesses spend less money for research and development. They spend less money on hiring. They spend less money on upgrading their software and IT, things like that. And then all companies get impacted. So that's the fear, and that could happen. But if it happens, you have to have the mindset of, hey, man, I'm still working. I'm in my 20s, 30s, maybe you're in your early 40s, whatever it is, but you're not retiring tomorrow. You take that opportunity and say, hey, man, if I can put another $10,000 in while the market's down or whatever, in 5 years, think of what that's going to be worth. For me, that's the mindset. I know that it's not popular opinion, especially on YouTube. People like to make videos that the market's going to crash 90%. You should panic sell. That, to me, gets attention. They're just trying to get views. I don't necessarily need views. I appreciate your views, and I like to do YouTube, but I do this for fun. I'm financially independent, and I try to just bring information to help you, the listener, if you're watching right now. But at the end of the day, I'm not trying to be a governor. I'm not trying to have millions of followers. If it grows, great, but I'm going to be me. I'm going to keep being me and do what I think is best. I'm trying to basically, if I was talking to my 20-year-old self, here's what I would tell myself. That's what I do when I talk to the camera and have these real talks. So I hope this is helpful, guys. You should definitely check out Discord. It's worth every cent. We have a great community in there. Nobody has been panicking at all this entire time. You can check it out. Go to Patreon, Fired Up Wealth. The community, the reason that the community costs money, if it's free, it turns into a dumpster fire because the quality can't be managed. So by having that fee to get in, it basically is a quality control measure. And at a certain point, I've said this to my members, we'll just close it down to new members. And I want this community to be a tight-knit investing club that we can grow and learn together and outperform the market and achieve financial independence. The idea is not to get thousands of people and to make a bunch of money on it, nothing like that. I really enjoy it. I'm the coach, kind of the leader of that community. We've got lots of smart people from 30 plus countries. I encourage you to check it out. You can join Elite. There's a couple ways to do it. Check the link in the bio. The worst case, you don't like it, cancel anytime. But I appreciate it, guys. We're in Discord talking about this stuff all the time, sharing our buys and sells. making sure that we're there to help people if they have questions, things like that. If you need a community and you like having that community environment, in my opinion, you won't find anything better, high quality. If you're an investor, long-term investor, focused on financial independence, Fired Up Wealth Discord is the place to be. So check us out. You can also follow on Twitter and the other platforms. I appreciate your time and attention. Hope you have a great rest of your day. Take care.